Greetings, it's time for another CrashWatch video, especially since we are experiencing something that can be called a head fake or a dead cat bounce or a bear market rally, whatever term you would like to use, so people are getting complacent again. We're going to look at the VIX index for information about what the future may hold on this front, so really digging in deeper to see what exists beneath the surface. So let me hide my face here. This, of course, is the S&P 500, the 2-year chart. And those of you who have seen my prior CrashWatch videos know that I identified this left shoulder, head, and right shoulder pattern as a head and shoulders pattern, and it broke. Now what happened after that is not exactly what usually happens after a head and shoulders pattern. Usually it's straight down into a deep correction. Here we're seeing some meandering. It's going lower, lower highs and lower lows, so 2 steps down, 1 step up. But now you have this temporary rally over here. And why do we have this temporary rally over here? This is in the face of the US Federal Reserve raising rates at a very rapid and excessive speed. They should not be raising the Fed funds rate at all. The balance sheet unwinding, the quantitative tightening in the US is underway, and other central banks in the world have tightened even more. They're unwinding the quantitative easing they did for COVID, as you can see in this video up here in the upper right-hand corner. There's already a large amount of deprinting going on, which is of course bearish for stock markets, and could take us back to where we were pre-COVID. Now, I don't think it can go that far because the market will correct before they let central banks tighten by that much. But here now we have this rally. After this low that was as low as 36.63, we're up to 4,100 plus. And this is what is known as a period of complacency. Usually happens at this time of summer, but also because the second derivative of bad news is no longer quite so much, because many people, even if academically they understand the difference between high prices and rising prices, or between a bad situation and a worsening situation, often feel good just when the situation has stopped worsening and it's still bad, or when prices have risen a lot but are not rising anymore. And this is what is happening over here. So let's look at oil prices, because that's the reason we are seeing inflation right now. And it's not because of central bank quantitative easing or anything like that. It's because the US government decided to obstruct domestic oil and natural gas production, causing a temporary spike in the prices of those two energy commodities. So we go to oil price. This is United States Oil Futures Fund, West Texas Intermediate Oil Futures. It's been rising, rising, and rising since the Biden administration came into office, because they announced very clearly that they were going to obstruct oil and natural gas fracking that occurs in North Dakota and Texas, as well as cancel the Keystone XL pipeline, which was almost completed. And they probably thought that they could raise oil prices from $50 a barrel to some equilibrium point of $80 a barrel, because that would speed up electric vehicles and other adaptations away from oil consumption. And this is an example of when the government thinks they can create some optimal conditions by threading a needle. They fail to account for all of the various other factors that can occur. The right hand was not talking to the left hand, and the US State Department was obviously provoking Russia into an invasion of Ukraine. It's something that they've been engineering for quite some time. When oil prices went from $50 to $80 a barrel, Russia became emboldened and decided that they could invade Ukraine. The last time Russia invaded Ukraine was 2014, which was also the last time oil was above $100 a barrel. This caused an oil spike, and it rose all the way up to $120 a barrel in oil price. Now it's come down somewhat. Now it's a little bit under 100. And just because it's come down from 120 to 100, even though this is high relative to what it was even in February, people suddenly don't feel quite so bad anymore. Gasoline prices are below the highs of a few weeks ago, but are still much higher than they were in 2020 and early 2021. This causes a bit of complacency, and it does cause the inflation reading to moderate somewhat, even though the effect of high oil prices is still percolating through the economic system. And that's what I've been predicting in terms of how a high oil spike just attracts more technological disruption and inflation goes away very quickly, because inflation attracts technology, which then crushes down the inflation. That's why quantitative easing has to go on forever. But this is one element of complacency. Now we're also going to look at another index that measures fear and enables some degree of predictability, which is the VIX index. So this is a website called VIX Central, and obviously it's a website from the 4:3 aspect ratio era, not the 16:9 era, but still has good real-time data regarding VIX futures. And what is the VIX index? This green line is the VIX spot price. It is not a tradable entity. It's just a mathematical calculation of what people are willing to buy for put options on the S&P 500 at a given time, which is one way to measure fear in the marketplace, specifically fear about the performance of the S&P 500. And these blue dots are future VIX prices as tradable under VIX futures. So this is the August VIX future, and that is its price. This is the September VIX future. And these prices move ahead as they get closer to expiry. As you can see in the August future, there are 9 days left, and these are calendar days, not trading days, because it expires on Tuesday always. The September future has 44 days left. The October future has 72 days left, and so forth. Each future usually has 4 to 5 weeks in which they are the frontmost month on the future. As the August future expires, the September future comes to the forefront. And the gap between these two is a word called contango. That's an actual word, contango, and that's the percentage difference between the two front month futures over here. Contango between 1 and 2 is 9.89%. Contango between 2 and 3 is 5.6%. And as this front month expires, 2 becomes 1, 3 becomes 2, and so forth, and then you have this contango. And every day there's a roll of 1 day worth of futures from the front month into the second month, and 1 day worth of second month into the third month, and so forth. And they're entire exchange traded funds that help you to trade these things. But what this tells us about fear is, now that we are in a contango type situation with futures this high, because the VIX spot price equilibrium is usually in the 19 to 20 range, this shows that the fear is temporarily dissipating, but will only dissipate for a certain amount of time, a matter of weeks, 3, 4, 5, 6 weeks, something like that. And then we could have a period of heightened market volatility again. That's not just because these further out month futures are at a certain level, but because this level of relief and contango has to revert back to a stage of much less contango and more volatility and agitation in these futures. Now, this is a very, very sophisticated topic that I will go into in considerable detail at some point in the future. One of the classes I have taught at Stanford has been about exactly this, options and futures. I also earned extremely huge return for a period of about 4 years, 70% a year for 4 years, 2010 through 2014 or so. I actually earned, after which it became too hard to do that. Otherwise, I'd still be doing that all the way up till now. But there's still a lot of opportunity in just knowing about things like this, even as relates back to the S&P 500. Because remember, this is a future expectation of what the VIX will be at the expiry time of this month's future. And since all of these are so much higher than the spot price, there is a continuous decay from contango rolling that happens every single trading day, and therefore a decay in these futures, and telling us about S&P 500. So now we go back to the S&P 500, back here to the S&P 500, which was a 2-year chart, but now we go to a 5-year chart. You see it's still quite high. And because of the amount of money printing that was done, which is an appropriate amount, they should not be unwinding it, it rose in response to all the COVID stimulus. We have to correct back to what is a trend line level, which I believe is the low 3,000s over here. And an overshoot from the trend line level downwards, because people are in excess fear. Hey, if we can be this far above a trend line level, we can certainly be somewhat below a trend line level too. Could make it go lower than that, but I still say low 3,000s is the ultimate bottom. And does that happen as soon as October? 2.5 months away, or later than that? That remains to be seen. Remember, the tightening is accelerating, tightening by the Federal Reserve of the United States as well as other central banks of the world. So don't let this dead cat bounce necessarily be a reason to think that the worst is over, because these types of relief rallies are designed to trap certain people who aren't looking at the big picture. That's why I put a 5-year chart over here. This level is very high compared to even 2019 levels. Even the correction level I'm talking about is higher than it almost ever was before 2020. So think of it that way. And under the accelerating rate of change, we do expect this gradient to steepen, but not this much, right? So a number of variables to think of. And I hope that that brief instructional segment about the VIX index and VIX futures was informative and expands the arsenal of subjects that you are able to internalize and use to think about what is happening from a big picture perspective. Now, if you found this type of video to be useful and you would like to see more videos like this made, I encourage you to subscribe to this channel, and thank you very much for watching.